All right. How's it going, everyone? Welcome to the October edition of the Investment Committee webinar. Glad to have you guys back. We're going to walk you through a market update, talk about some recent news stories that we've seen over the last month, and also dive into some charts and graphs that we think are interesting.
That we know are interesting.
We know are interesting. Thank you. So starting off with a review of the market vitals, looking at the S&P 500 so far in 2025, it's up just over 15%. So another strong year for the market in general. Over the last month, it's up 1.1%. And if we take a look at some of the other major indices in the market, we can see that all of them have had a positive month. We can see the NASDAQ 100, which is technology heavy, has had the strongest 1 month out of these major indices, up just over 2%. So that goes along with the theme that we've been talking about for most of the year in these webinars of technology and artificial intelligence being a major storyline in 2025. And another thing worth noting is the international stock index up almost 20% year to date. So that's been another theme this year. That's been a bit of a divergence from the last decade or so where international has really underperformed. 2025, it has been one of the best performing indices, up 28% year to date. What are we seeing in terms of some of the other sectors, Brandon, both year to date and in the last month?
Yeah, from a year-to-date perspective, Sean, to your point, technology leading the way, being up around 24%. I think two interesting takeaways from here are utilities, which are up 22% year to date, and in the last month, about 7%. And this is really stemming from some of the rising demand for, utilities through applications like data centers to really power all the AI infrastructure that's coming along, especially with the investments from, all these large technology companies that are building out. That's really going to have a rising demand for the utility sector. Another point is healthcare, where you see it up about 7% year to date, but those gains have really come in the last month, being up about 6%. And while we've seen that, since April, it's been trading around a low, you have seen that pop in the last month, where it hasn't really quite caught the rebound, where if you see the S&P or technology, so from that aspect, it will be interesting to continue to see, is that trend following, or is it really just a blip on the radar in the last month? Because if you take out the last month, you'll see it's basically flat on the year. So something just to really look at as you see, compare the sectors of, yes, what has it done year to date, but also in the near term, how much is that benefiting that year to date number?
Yeah, I
One
think
one
so.
one number that comes off the page for me is money market at 4%. So, you look at all the numbers you guys have up there year to date, they're all stellar. Everything, obviously a little bit with the exception of consumer staples and healthcare. If you had your money in a market, I don't even care which market, you're a happy camper. And money market, which last year, if we were having this conversation around this time, would have been closer to 5%. It's now at 4. When we have this conversation in a year, it's probably going to be closer to 3. And that's going to create a little bit of discomfort for people who, have kind of fooled themselves to think money market's going to solve their financial problems. It's going to become more and more challenging as you look forward. So expect next month to see that number probably lower. Expect in 6 months to see that number significantly lower, and in 12 months, probably a whole percent lower.
Yeah.
And that's something that, investors are going to have to face and deal with is interest rates, the 10 years now below 4% as we sit here and chat today. Uh, I might argue that that number could also be coming down with the shorter end of the curve. And that creates upward pressure on the other numbers on this page. Lower interest rates usually lead to a different discounting mechanism for other asset classes. That goes for real estate, that goes for stocks, that goes for absolutely anything. So if interest rates come down, that's a big tailwind to the already great numbers we're looking at. There's some other challenges to consider and things to think about, but that's a big, big, big story that people need to stay focused on while we deal with all the other crazy headlines that we're about to talk about.
Yeah, that's great context. And one piece of stock news that I think is worth mentioning that fits into the storyline of artificial intelligence technology, that AMD and OpenAI deal, which happened at the beginning of October. We saw they struck a deal for AMD to provide a lot of the hardware and chips necessary to build out OpenAI's infrastructure. And we saw AMD soar 40% since that day, October 6th, to where we're sitting today. So I don't even think that's a bad thing for other chip companies like NVIDIA. It's really a matter of fact that they need more and more chips and hardware. They're not just picking one supplier in AMD. OpenAI has stated that they're going to still continue to need more and more from NVIDIA too. So this just goes to show part of why technology, utilities, communication sector are doing so well is just the amount of resources that are being thrown at artificial intelligence in general. And I think that AMD story is a great example of that.
And just a reminder, AMD's Advanced Micro Devices and OpenAI is the company which owns ChatGPT.
Yeah. All right. So looking at the 10-year Treasury rate, we're just under 4% right now. And we had a CPI reading come out this morning. CPI came in at 3% year over year versus the expectation of 3.1%. So we've seen a nice jump in equity markets off of that news, CPI coming in at that 3% level. We do have a Fed meeting coming up on October 29th, Wednesday, where the expectation is another 25 basis point rate cut. And just looking forward to the December meeting, another 25 basis point rate cut is priced in. So the expectation is before the end of the year, there's going to be another 50 basis points cut. But that'll be interesting to keep an eye on between now and the end of the year.
Yeah. And, one of the things earlier in the month with the government shutdown coming out was how's the economic data going to come out? And, the Fed continuing to say they're data dependent. There was some worry about, well, how are they going to, price that in or read through the context coming up in this October meeting? So while the CPI report was delayed a bit, it still came out today ahead of the meeting. So at least gives them some data to go off of for October and then continue throughout December.
But let's also keep in mind that 3% is not exactly a huge celebratory number. The Fed's target, long-term target is 2%. So we're a healthy 50% above that, 1% above where the Fed would like inflation to be. So, yeah, it came in below expectations. Yay, let's all celebrate and, dance around the halls. But at the end of the day, inflation is stubbornly staying higher than I think the Fed would like. And that's a challenge for them as they deal with a potentially slowing job market and, some other challenges, government shutdown, as you mentioned, and some other things they kind of see coming down the pike. So I don't think that they're in as easy of a position. I think everything you said there, Sean, is 100% correct. They're going to cut probably this month. They're probably going to cut again in December. Rates are a little elevated from where they could be. That being said, I don't think it's a home run. I could see Fed governors arguing that the inflation fight is still well underway and only in its fifth inning. So that they're not easily on one side or the other. They are still balancing the
Yeah.
potential risks to the economy, and that's where they really should be. They're kind of doing their job.
Yeah.
So as much flack and as much heat as they get, whether it be from political people or market people or anyone, it's not an easy position that they're sitting in. They've had much easier times in the past.
Absolutely. And just looking forward to December 2026, what the market's priced in. The expectation is there's going to be another 75 basis points cut from the end of 2025 to 2026. So that would be 125 basis points from where we're sitting today to the end of 2026. And as Jordan mentioned, inflation at 3%, that's way above that 2% target. It's hard to see them cutting that 125 basis points if we start to see that CPI number tick up even a little bit to 3.5, something like that. So that's why it's so important that the Fed stays data dependent and really caters their move to what they see in the economy.
Yeah, and the Fed was supposed to cut a lot more this year than they actually have.
Yeah.
So, they've had their foot hovering over the brake pedal on what the market anticipated from them.
Mhm.
And like you said, Sean, the expectations are another 75 basis points cut next year. That's going to take the rate, below 3%. Um, and I think while these next two cuts are probably already baked in the cake, those further cuts next year are not baked in the cake. I think that the market might be a little ambitious on that front. And while we are likely to see a new Fed governor come next May, uh, that doesn't change the fact that it's still a committee that is voting, and no one person has full control. They get to dictate the
Yeah.
conversation, the agenda, and all those other things, but they are not a king, if you will. And so the committee's got to kind of be on board with whatever that is. And as we said, it's not a home run. It's a
Sure.
challenge. It's a balance. All right, enough about that. Let's go.
So some recent news stories that we wanted to discuss. One thing that has been a big topic of discussion in 2025, gold, cryptocurrency, and the US dollar. So looking at how all of those have done so far in 2025, the US dollar index is down about 9% so far this year. If we look at some of the major cryptocurrencies like Bitcoin and Ethereum, those are both up just over 15% so far this year. And I think the biggest surprise on the page so far, gold up 55% so far in 2025. So that's an asset that we often think of as a safe haven asset, an inflation hedge. It's pretty incredible to see that that is up 55% through 2025 and the year's not even over yet. So with the US dollar weakening, we've seen some of those other stores of value or currency alternatives really excel. And looking at Bitcoin and Ethereum, yes, they're up 15%. If we look at 2023, Bitcoin was up 150%. 2024, it was up 110%. So even though they are positive this year, it's been much more tame than we've seen the last couple of years. So I think that's worth noting. And it's really been gold that has blown the doors off so far in 2025. One,
I, Dude, if you had said this in January 1st, that gold would be up 55% and Bitcoin would only be up 15 and a half, being that
yeah,
Bitcoin is kind of digital gold in some people's mind. I know it's a Ponzi scheme in some people's mind, and it's, something else in others, and some technology tool, and so it's,
yeah,
with technology being up over 20% and gold being up 55 and Bitcoin being somewhere between technology and digital gold and whatever else you want to call it. And with the
mhm,
regulatory changes we've seen, and Ethereum being exactly the same number, right? So it's not like one of them caught a cold and the other one, is doing great. They're
yeah,
kind of doing the same thing. I would have lost this bet every time, because Bitcoin's more volatile than gold. Maybe it's through some depressed stage or something like that, but there's no world where gold should be up 55. And if Bitcoin truly is digital gold, Bitcoin should be up less. And I mean, you kind of said why. Like Bitcoin's had a huge run in the last 2023, 2024. So
yeah,
2025, maybe it's a little bit of an exhale. I'm not some, Bitcoin, crazed person. It's just something that's behaving in a certain matter, and we see it, and so we have thoughts and ideas about why, and we're consumers of news and other people's ideas. But I think just on its face, that is an interesting relationship that we've seen this year between those assets, and it really jumps off the page the way you guys, have presented it here. It's like, oh wow.
yeah,
Like it just looks like
yeah.
Bitcoin's done the reverse of the dollar, which makes sense, right? Because
Mhm.
Bitcoin was all about moving away from fiat because fiat was going to be devalued. So we needed an independent way to value things. In Bitcoin is kind of the premise, the white paper that it was based on. And it's just nuts. I mean, it really makes you wonder what the heck is going on with all the gold buying. The gold is
Yeah,
up 55%. Which is wrong here, right? Bitcoin, dollar, kind of inverse, a little bit extra for the technology boost. makes sense. I could see it up more, that wouldn't offend me. Gold up 55? Gold didn't just get invented. Like it's been around and it's
Yeah.
kind of played the same role and it's just as heavy and clunky as it's always been. So that is just it feel like the rug got pulled out from under me on that one.
Yeah, even from like a news perspective, you obviously Bitcoin, AI, technology kind of driving the news, where there's not, where the article is talking about the performance of gold. I mean, obviously you can find them, especially if you're really, into investing as an individual. But, if you just kind of Googled them or looking around, I feel like you wouldn't see it nearly as much, even though it does have that outperformance.
Well, that's actually interesting you mentioned AI and everything here because, Bitcoin is all about, kind of digital security. And with AI, as we know with cybersecurity risks and everything else increasing this year, maybe some of the Bitcoin hesitancy is, well, it's digital. It's not, I can't take a bite out of it like I can of gold. Maybe just there's a perceived higher risk there for investors. That's why this stuff's complicated. It's just not, third grade simple. Like this has a
Yeah.
lot of components to it. Anyway, let's move on to
Yeah.
consumer squeeze. That's a juicy one.
Yeah. So the consumer squeeze, there's a few factors that have really hurt the purchasing power, I think, of a lot of consumers in the US so far. Healthcare costs have been a major one. They've risen significantly in 2025. The expectation is it's just going to continue in 2026 in terms of the cost of healthcare. That's because of drug prices, inflation. The population is also just aging, which puts more stress on the healthcare segment in general. Another factor that's aiding this consumer squeeze or making it worse is the AI and technology advancement. So as Brandon mentioned with data centers, in terms of the utility that's needed and the energy that's needed to power artificial intelligence in these data centers, it's just put more stress on the power grids, the energy that's needed, and that's resulted in higher cost for both individuals and businesses in terms of energy. In terms of consumer spending, um, for lower and middle income households, that's where we've seen the biggest effect. I think high income households have still been able to maintain a lot of their spending habits, but many consumers are absorbing some of this burden that's been put on by these tariffs as well. So that's been another factor with the trade wars, the uncertainty around tariffs that has led to a little bit lower consumer sentiment and has affected the spending of some of these lower income and middle income households.
I'm willing to fall on the sword here. Everyone who's listening to this and consuming this information should take pause for a minute, take their politics, chuck them out the window, and focus on the things that you just mentioned. This is going to potentially be the story of 2026. Right there. Healthcare costs.
Yep.
We are going through a government shutdown right now because of a expiring of subsidies for healthcare costs for people. That's what it's about. That's where they can't meet. That's going to be an issue. I don't know if it, I haven't been able to go through the data yet, but some people have said that the numbers are going to go up significantly, and that's going to be a major hit, right? The government's been paying for it. Now people are going to have to pay for it. And if you look at GDP, it's a combination of consumer spending and government spending. Government spends less, consumers have to spend more. That's the way that works. AI and technology, it's not slowing down. We can't make a nuclear reactor in the time that people are building out these infrastructures. And it just takes time. And there's going to be a mismatch at some point of data of energy demand and energy supply. It's coming. It's not a question. It's just how disruptive is it going to be? And consumer spending, this has been a story for a long time. Unfortunately, America has not done a good job of spreading the wealth. Wealthy get wealthy, lower income just gets more difficult every year. That's why we have a lot of political unrest in this country. And we're not doing anything to fix that. It's just not happening. And, we're moving our taxing structure. When you think about it, we extended the tax breaks earlier this year in June. And how are we replacing that tax income? We're adding a sales tax. That's what a tariff is, just sales tax. It's a sales tax on stuff not made here. And sales tax impacts everyone. If you have high income and you're able to come up with some good tax strategies, which is a good thing, by the way, that's what we do for our clients. But what it ends up meaning is that consumers who are, the 99%, not really the 1%, the 1% benefit from the lower tax rates, the 99% end up paying higher sales tax. And that is a bigger percentage of their income than it is for the wealthier. That's just what's happening. And that's going to be a big, big story, I think, next year. We go into the midterms next year. Politicians are going to be screaming at the top of their lungs. There's going to be a big story next year. So, those 3 points: healthcare costs, demand for energy, and how we are collecting tax revenue and who's benefiting and who's not. Those are going to be very big stories next year. So, and I'm
Yeah,
willing to fall on the
definitely.
sword on that one. We can do a
Yeah, I
time.
think
So
the
one
AI
year from now,
optimism,
one year from now, let's check that. Let's go back and be like, here's what Jordan said back in October
run the tape.
2025.
Yep.
It's October 2026. How much of an idiotism? Let's see it. I'm
I'll
willing to
put it on
fall on
your
the
window
sword.
right here.
I'm willing to fall on the sword on that one. Let's go.
I love it. I think right now the AI optimism is just kind of clouding everyone's mind. That's been the storyline, but I think you're right. These are going to be major stories.
That's a big story. That's a big story. No story
Yeah,
is greater than the other, but this story is one that's been kind of hiding.
for
All right,
sure.
let's go. Oof.
All right, so here we have two charts, and we'll get into them in a second, but it's comparing the S&P and the Barclays Ag and their correlation, and then it's also the second chart comparing the S&P and the Russell 1000 value. So, correlations really just how two asset prices are moving in relation to each other. If they're positive, moving together, or if they're negatively correlated, moving, inversely or opposite directions. So I feel like generally, if you looked up how are stocks and bonds moving, you're typically going to find that they have an inverse relationship. If stocks are going up, bonds are going down, and same with the other way around. So you can see in this first chart in 2020 that the S&P and the Barclays Ag were negatively correlated. But you can start to see that trend, to the top right, and it turning more positively correlated. And this really started, at the end of 2020 and then into 2022, where we saw rates get raised and also high inflation. And during that time, that year in 2022, the S&P was down about 18% and bonds were also down about 13%. So it was a challenging time that year since, both were actually down. Um, and then the next chart, the S&P versus the Russell 1000 value, you can see at the start of 2020, they were almost had a correlation of 1. So they were moving really closely together. And, as time continued, you start to see that trend to the bottom right corner of the graph or become less correlated with each other. Some of that reason, if you look at the holdings in the S&P, about the top 10 holdings make up about 38% of that. And there's a lot of concentration in, the Magnificent Seven, large technology companies, where the Russell 1000 in the top 10 holdings, there's about an 18% concentration. And yes, there's some technology companies, but, there's also more diversified across, value in general. If you look at Berkshire Hathaway or Exxon, and, it's really an interesting point to way to think about, allocation of funds where go back to 2020, the Barclays aggregate and bonds were a big diversifier. But even if you're just looking at equities, you're starting to see a different trend where, there's a less correlated just because it's value or S&P or growth. There's a little bit different of a story, and it's not just, oh, you're invested in value, you're invested in the S&P, they're going to move together. That's not necessarily the case before. While there still is a higher allocate or correlation between equities and bonds, it's not as drastic of a difference.
Yeah, that was fantastic, Brandon. You had a little bit of jargon in there, so I'm just gonna do a
That's
very
fair.
quick translation. So when he says Barclays aggregate, what he really means is bonds. So S&P is the typical way that we measure what equities are doing, and the Barclays aggregate is basically the bond index that we typically look at to figure out what bonds are doing. So that first chart on top, that is bonds and the general stock market's relationship. And as he mentioned, it's typically been somewhere between zero and negative. And now we see it kind of drifting a little bit more positive. And this is partially because of how important inflation is and, how levered our society has become. And so bond rates are driving a little bit of stock rates. And that relationship we've just seen kind of shift a little bit. And this is part of why, you need to kind of be always watching history and how it evolves. The next chart on the bottom, and I think what you were saying is the S&P, that general index, is kind of the stock market plus the Mag 7 and the Magnificent Seven, right? The seven biggest companies, the ones we, always hear about: Apple, Amazon, Google, Tesla, Facebook or Meta now. Those are the ones that are really driving the stock market up. And if we look at that value index, it doesn't have as much of that stuff in there. And that chart really shows how the Magnificent Seven stocks are kind of just walking their own path while the rest of the market is kind of trying to keep up, but it's becoming a little bit detached. And I think that's what you were saying. Is that about correct? Was that?
That was a good summary of it. Yeah.
I love these two
Yes.
charts. This is a great story. I love this.
It is. It's super interesting to just look at the trend lines. If you were to draw a single trend line on both of these charts, so you got the top one up and to the right and the bottom one down and to the right. So even on an absolute level, the S&P and the value index are still slightly more correlated than the S&P and bonds. But if we're looking directionally, there's a major convergence that's been happening over the last few years. So that's something to keep an eye out for.
And also for those who aren't like completely familiar with the concept of correlation, correlation is something does one thing, another thing does something similar. So highly correlated things, that thing turns right. Highly correlated things turn right with it. If you're negatively correlated, that thing turns right, the other thing turns left. So when we see correlations going up, that means they're doing the same kind of stuff or similar kind of stuff when they behave. And when we see correlations going down, it means they're doing less similar things. So, I don't know if that was helpful. That's probably not the best correlation analogy I could do, but that's what we're working with today. Let's go.
Let's go. All right, guys, that's all we have for you for the October webinar. Appreciate you tuning in, and we will see you again next month.